Ladies and gentlemen, welcome to the year of the snake 2025. If you are doubting, yes, the snake moves very fast, very quick. The snake can be full of wisdom. At the same time, the snake can be dangerous. Now, in this week's video, I will actually share with you essentially how I survived in the last 3 years of the snake. That means the 3 prior snake years, and how you should be positioning your portfolio for 2025, the year of the wooden snake. Now, also, I want to share with you actually how does one prepare physically, physiologically, as well as psychologically for the year of snake, so that your portfolios will be able to reap the millions in profits as what we have always done in the last few decades. The first snake year, ladies and gentlemen, that I experienced was way back in 1989. Back then in 1989, when I first graduated, I was a rookie. Essentially, on 13th of October 1989, the stock market crashed a whopping 13%. Yes, you can see that in the Los Angeles Times. You can see that this is only a very short memory because 2 years prior, that's in 1987, on a single day, the Dow crashed 23%. That was actually on 19 October 1987. So when it happened again in 1989, everybody was very skeptical, very frightened. But guess what? The year 1989, the market ended up positively. Chart, ladies and gentlemen, on how the market performed in 2001. 2001 was really bad in the snake year because essentially it had 2 episodes of downtrend. One was actually a continuance from the dot-com bubble in the year 2000, which continues to see the downtrend in the first half of the year. And the second half of the year, the market was actually rocked by the September 11th bombing, when the fighter planes went into the buildings itself. And guess what? 2001 ended up low. But if anything, ladies and gentlemen, the lesson to draw is that formed the bottom of the market, because in the subsequent 5 years, as you can see from the chart, ladies and gentlemen, the Dow went on and the S&P went on to double in just 5 years. So lesson learned, ladies and gentlemen, that I've learned in my first 10 years when I was in the market was this, and that's continued and has become the staple of our investment strategy. That is, I've been quoted many a times to actually bet big in times of crisis. That's because my formative years, I was actually introduced to the 1987 crash, 1989 crash, the 1990 Gulf War, the 1997 Asian financial crisis, and then the 2001 snake year. It's been our principle, and that's what we have been teaching and sharing in our investment classes since then. Bet big in times of crisis. Now, many a times, ladies and gentlemen, you have always heard, buy when there's blood on the streets. Now, ladies and gentlemen, let me tell you, it's easier said than done, because there are many commentators who are actually just reiterating what the text actually says, but really to live it all is a different thing altogether. And that's something that we bring to our class, the emotions, the emotive aspects that actually shape your. Then the third snake year, ladies and gentlemen, 2013, was really smooth sailing, other than in the early part of the year. That was actually in May when Ben Bernanke says that there would be taper tantrum. But guess what? The market just went on to rock one of the best returns. It was up 26%. And in fact, if you look at this chart here, and since the last 20 over years, the 2013 has been one of the top performing years after 2023, when the market was up 24%, and 2024 just last year when the market was up 23%. You'll be asking, therefore, ladies and gentlemen, so what holds ahead for 2025? Some blinkering questions you'll be asking is, hey, after 2 years of outperformance, surely the Dow and surely the S&P will give way. Is it as straightforward as that? That's what we attempt to answer in our investment class as well as this video. So stay with us to the end. How does one prepare physically, physiologically, and psychologically, for the snake year in 2025? Now, first and foremost, let me share with you, ladies and gentlemen, when I actually left the industry. Yes, ladies and gentlemen, this was an article chronicling, when I was head of institutional sales at DMG, and prior to that was at Philips Securities, as well as a few of other eminent stockbroking organizations in Singapore, where I was head of institutional sales before I retired in my early 40s. Just to quote the newspaper article, it says, a well-known stockbroker personality, Gabriel Yap, is quitting the business to travel and to do charity work. Yes, ladies and gentlemen, this is what I did. But one of the key things that I did when I actually left the industry was this. I shifted the bulk of my investments into the US market. And yes, ladies and gentlemen, look at this chart here. This shows the performance of the key markets from the S&P 500 down to the Indian market, Sensex, the Tokyo market, TK, ASX Ordinaries, that's actually the Australian market. Yes, ladies and gentlemen, one of the reasons we left the Singapore market was we went to settle down in Melbourne. Yes, this is our 16 year living there. So if you are in Melbourne, just give me a call. The US market has been the most fantastic outperformer in the last 16 years. But more importantly is that it's up a return of 600% in the last 16 years. Yes, ladies and gentlemen, 20 million then would now be worth more than 100 million. This is the kind of returns that you can get investing rightly in the US markets, in the right sectors. And that's why we are so excited. Now, can Singapore markets actually deliver? No way, ladies and gentlemen. No way. And that's one of the key strategies, avoiding the markets like Singapore, and going into markets that can multiply your wealth. That is key. And that's what we teach in our investment class. In making your money, ladies and gentlemen, making your millions, as I've written in my book, Making Millions, in this case was for real estate investment trust, which I think the era is over. So where to make your millions next? And the Chinese equivalent, which is a bestseller in China, one must be able to figure out, the key momentum that is actually driving earnings. And look at this chart, ladies and gentlemen. As long as earnings in the S&P this year, it will go up further to 274. That's the market consensus from 269 last year. We are therefore, being powered and being supported by earnings growth. So it is not a case where because the stock price has gone up that much, but it's more because if the EPS continue to grow, that will continue to give you support in your share price uplift. And that's where a lot of people have missed the point. That is actually, other than buying really big in times of crisis, the other principle that we teach is actually follow the money. Because, essentially, if there is area where money can be made, that's where you should be looking forward to. So for example, look at this chart. For the longest period, the red line and the grey line follows each other. Now, then you can see that as the red line continues to increase since the last crisis, that is actually the red line represents the profit by US corporations. The grey line, which is actually the market cap of US market, actually continues to go up and even widen. So this means that the market value of US companies vis-a-vis the profitability has been increasing, especially in the last 3 years. And it's not surprising. And that's why people are actually guesstimating, has the US market actually gone up too fast, too quick? So that's always been something that's holding back a lot of Singaporean investors. But is this the valid point? 2 weeks ago, ladies and gentlemen, I shared with you, my video, how I made 1.3 million on Alphabet A shares. Yes, ladies and gentlemen, this is my latest based on last Friday's Alphabet A share price. You can see that I hold 12,400 shares. This is actually in the equities portion of my UBS private banking account. You can see that it's worth about $3.34 million. So if you work backwards, ladies and gentlemen, in last 3 years alone, my profits in Google A has actually grown to 1.4 million. So my cost of 1.9 million, I have topped it up on a profit of 1.4 million. So stay with me on this journey, ladies and gentlemen, because in my last video, I've mentioned that I will continue to keep Google shares for reasons as enumerated and shared with you in that last video. 2 weeks ago, you can actually look at the details. The link is actually below. But one of the key things I want to share with you is this, okay? So this is the share price chart of Google. You see that the share price when I first bought it was 115, 110. Now it's gone up to 200. And I told you that essentially that I see no reason why I should be selling it. In fact, with my profits actually powering even higher this week, because Google closed at historical high above 200 for the first time after the 1-for-20 split. Yes, ladies and gentlemen, one of the key things to be excited about the US market is that you actually have great stock split. So the likes of Amazon gave me a 20-for-1 stock split. Then for one share, you get 20. For Google, they also give me 20 shares for one share. Does this happen in Singapore market? Tang gu gu. Notice that we're concentrating on two key sectors other than real estate investment trust, that is actually on the US tech sector, because a lot of people basically have done very well for us as well on the Magnificent Seven. But where will the Magnificent Seven go? Which are the critical things to focus on and to know, if indeed they will continue to power and the share prices will power higher. And one of the sector that I'm most excited about is the cybersecurity sector, which I will share later in this video to share with you why my optimism and why I'm actually going to spend, half a day in my class on the 8th of February on this particular topic. So in relation, therefore, ladies and gentlemen, if you can see, this is a chart showing essentially why the Magnificent Seven stocks, that is actually the likes of Alphabet, the likes of Amazon, Apple, the likes of Nvidia, Tesla, will continue to power ahead this year. If you look, therefore, this is the free cash flow, ladies and gentlemen. Free cash flow, ladies and gentlemen, is, as defined by Warren Buffett as well as actually in the book, is the cash available to shareholders of company after capex is minus off, after operating cash flows is actually the operating capital expenditure is required for. And you can see, ladies and gentlemen, in the last 8 decades or so, never have Magnificent Seven free cash flow been higher than any other decades. So, ladies and gentlemen, if you ask me, therefore, is the huge expenditure on artificial intelligence by the big 7 companies misplaced? Well, this chart shows otherwise.